So you're browsing residential properties online late at night, and every single house that doesn't look like it belongs in a demolition catalog costs at least $500,000. The kitchen counters look like they're from the early 2000s. The carpet is that sad beige color, and somehow the real estate listing calls it a perfect starter home. And you're sitting there wondering, did I miss something? Did everyone else get a massive raise that I somehow didn't hear about? Here's the truth: it's not you, it's the math. And today, we're going to break down exactly who can actually afford a $500,000 house in 2026. Not who the bank says can afford it, but who can genuinely sleep at night after signing those papers. Stick around, because what you're about to learn might completely change how you think about buying a home. Welcome back to the channel. If you're new here, we break down personal finance topics in a way that actually makes sense, without all the confusing jargon or unrealistic advice. Today's topic hits close to home for millions of people, literally. In dozens of cities across America right now, $500,000 is just the baseline price for an average house. Not a luxury mansion, not a sprawling estate, just a regular 3-bedroom, 2-bathroom house with a tiny yard. But here's the uncomfortable question nobody wants to answer: who can actually afford this? We're going to walk through the real numbers together: the down payment, the monthly costs, the hidden expenses, and figure out what income you actually need to make this work without turning your life into a constant financial stress test. Let's dive in. The affordability disconnect. First, let's establish some baseline facts about where we are right now. The median household income in the United States is around $84,000 per year. That's the middle point. Half of households make more, half make less. Now, a $500,000 house represents about 6 times that median income. Think about that ratio for a second. You're being asked to buy something that costs 6 times your annual salary. Historically, the healthy ratio was closer to 3 times your annual income. So if you made $80,000, you'd be looking at homes around $240,000. But that ship has sailed in most markets. In cities like Austin, Denver, Seattle, or anywhere within reasonable commuting distance of a major metro area, $500,000 is what you're expected to pay for something ordinary. This is the new normal, whether it makes sense or not. So why does this feel so impossible for so many people? Because the math genuinely doesn't work for most households. But everyone keeps telling you it should work. Your mortgage broker says you're approved. Your real estate agent says prices are competitive. And maybe your parents remind you they bought a house on way less money. The difference? The system has changed, and not in your favor. The down payment challenge. Let's start with the very first obstacle: the down payment. The traditional advice is to put down 20%. On a $500,000 house, that's $100,000 in cash. Let me repeat that: $100,000 now. The median savings account balance in America is around $8,000. So right off the bat, most people are $92,000 short of the traditional down payment. You might be thinking, okay, I'll just save up for it. Let's run those numbers. If you're earning that median income of $84,000 and you manage to save 10% of your gross income, which is already pretty aggressive, you're putting away $8,400 per year. At that rate, it would take you almost 12 years to save $100,000. And that's assuming housing prices stay exactly the same during those 12 years, which we know they won't. So what do most people do? They skip the 20% down payment and put down 5 or 10% instead. Let's say you save up $50,000 for a 10% down payment. You've just unlocked a new expense called PMI, private mortgage insurance. PMI is essentially a penalty fee for not having enough money to put down 20%. You'll pay somewhere between $200 and $400 every single month for insurance that protects the bank, not you. It's there because the bank is worried you might not be able to pay. So you're literally paying extra money each month because you weren't wealthy enough to begin with. Keep this number in mind. We'll come back to it. The real monthly costs. All right, so you've scraped together that $50,000 down payment. Now you have a $450,000 loan. Let's talk about what your actual monthly payment looks like. With current interest rates hovering somewhere between 6 and 7%, your monthly mortgage payment, just the principal and interest, will be around $2,800 to $2,900. But that's not where it ends, not even close. Property taxes. Depending on your state and local area, you're looking at $4,000 to $8,000 per year. Let's split the difference and call it $6,000 annually, which works out to $500 per month. Homeowners insurance. This has gotten way more expensive in recent years. With climate-related events making insurance companies nervous, you're looking at about $250 to $350 per month, depending on where you live. Maintenance and repairs. Here's the one that catches everyone off guard. The general rule is to budget 1% of your home's value each year for maintenance. On a $500,000 house, that's $5,000 annually, or about $420 per month. This covers things like when your water heater dies, your roof needs repair, or your HVAC system decides to quit in the middle of summer. PMI. Remember that penalty we talked about? Add another $200 to $400 here. Let's add it all up. Mortgage payment, $2,850. Property taxes, $500. Insurance, $300. Maintenance, $420. PMI, $300. Your total monthly housing cost is approximately $4,370. And that's in a perfect world where nothing major breaks. Now, here's where it gets interesting. The income you actually need. Financial advisors have this guideline that you shouldn't spend more than 28% of your gross monthly income on housing costs. This is the number that keeps you financially stable. Banks are a bit more lenient. They'll approve you as long as your total debt payments don't exceed 43% of your income. Let's reverse engineer this. If you're spending $4,300 per month on housing, and that should represent only 28% of your income, you need to be making about $187,000 per year. Even if we use the bank's more relaxed 43% rule, you still need to be earning around $150,000 annually. Here's the reality check. Only about 10 to 20% of American households make $150,000 or more. That means roughly 80% of American households cannot comfortably afford a $500,000 house under any reasonable financial guideline. This isn't opinion. This is just math. But people are still buying these houses, right? So who are they? Some have dual high incomes in fields like tech, medicine, or law. Some have family money. Maybe parents helped with the down payment or gifted them funds. And some are stretching themselves dangerously thin, living one emergency away from financial disaster. Let me show you what this actually looks like in real life. A real-world example. Let's imagine a household making $160,000 per year. That's well above the median. These are two working professionals in decent jobs. They should be comfortable, right? Let's watch what happens when they buy that $500,000 house. Their gross income is $160,000, but after federal taxes, state taxes, Social Security, Medicare, and maybe a modest retirement contribution, they're taking home about $9,500 per month. That's their actual money to work with. Now subtract that $4,300 housing payment we calculated. They're left with about $5,100 for everything else in their lives. Here's where it goes. 2 car payments, $800. Car insurance, $250. Gas, $300. Student loans, $600. Health insurance premiums, $400. Groceries, $800. Utilities, electric, water, gas, internet, phones, $450. That's $3,600, leaving them with about $1,500 remaining. And we haven't covered clothing, entertainment, kids' activities, medical copays, car repairs, or, most importantly, building an emergency fund and saving for retirement beyond that minimal contribution. This household is spending 46% of their take-home pay on housing, not 28%, not even 35%, almost half. These aren't irresponsible people buying luxury items. They're just trying to live in what the market calls a normal house. Here's what that actually feels like day to day. It feels like checking your bank account before buying groceries. It feels like saying no to things your kids want because that $35 might be needed if the car breaks down. It feels like lying awake at night doing mental math about whether you can afford new tires this month, or if you need to wait and just hope it doesn't rain. When the HVAC system breaks, that's $5,000 you don't have. When someone rear ends you, that deductible goes on a credit card. When your kid needs braces, you're financing dental work like it's a car purchase. This is the reality for households making $160,000. Now imagine households making $120,000 or $100,000 or the actual median of $84,000. At median income, buying a $500,000 house isn't just tight. It's mathematically impossible without massive help or accepting catastrophic financial risk. Why the system doesn't care. Here's what makes this whole situation particularly frustrating. Nobody in the transaction has an incentive to tell you this doesn't make sense. Sellers list homes at $500,000 because that's what comparable homes are selling for. Banks approve buyers at that 43% debt-to-income ratio because technically, the loan probably won't default immediately. Real estate agents encourage buyers to stretch because their commission depends on closing the deal. The system is designed to get you into the house, not to ensure you can comfortably afford it for the next 30 years. And once you're in, once you've signed those papers and moved your furniture in, you're trapped. You can't just walk away 6 months later when you realize this was a mistake, not without destroying your credit and losing your down payment. So people stay in homes they can't afford, working jobs they hate because they can't risk any income disruption, slowly watching their savings evaporate, wondering why they feel so stressed when they're supposedly living the American dream. Here's the harsh truth. For probably 70 to 80% of American households, a $500,000 home is simply not affordable. Not sustainably, not without accepting financial precariousness that would have been considered reckless a generation ago. This isn't about personal failure. This isn't about not working hard enough or not being financially disciplined. This is about a housing market that is completely disconnected from income reality. Home prices have increased roughly 400% since 1990, while median household income has only gone up about 180%. The math doesn't work. It can't work. And pretending it does doesn't help anyone. So what should you do? Stop looking at what you qualify for and start looking at what you can genuinely afford without turning your life into a financial tightrope act. Find the number where you can pay the mortgage, handle maintenance, save for emergencies, invest for retirement, and still occasionally not stress about money every single day. For most people, that number is nowhere near $500,000, and that's completely fine. You're not less successful because you're being realistic. You're not failing at adulthood because you refuse to financially drown yourself. You're just doing the math that apparently nobody else wants to do. If you found this breakdown helpful, make sure to like this video and subscribe for more honest conversations about personal finance. Drop a comment below and let me know. What's the housing market like where you live? Are you feeling priced out, or have you found a way to make it work? Thanks for watching, and I'll see you in the next one.